Most people wait until their RMDs arrive to think about Roth conversions. That is the single most expensive retirement tax mistake you can make. A 2024 analysis by Vanguard found that retirees who miss the pre-RMD conversion window pay, on average, significantly more in lifetime taxes. And for many households, the gap exceeds $100,000 in after-tax wealth. There is a window, usually 5 to 10 years wide, that opens when you stop working and closes the moment your required minimum distributions begin. Today, we are going to walk through exactly how that window works, how to measure how much you can convert without triggering a higher tax bracket, and the one Medicare trap that catches people completely off guard. By the end of this, you will know whether you are sitting on one of the most valuable tax planning opportunities of your financial life. Why the income window exists. Here is the setup. You spent 30 or 40 years contributing to a 401k or a traditional IRA. Every dollar went in pre-tax. The IRS has been patient, but not forever. Under current law, the IRS requires you to start taking required minimum distributions at age 73. That rule was updated by the Secure 2.0 Act, which Congress passed in December 2022. Before Secure 2.0, the RMD age was 72. Before the original Secure Act of 2019, it was 70 and a half. Congress has been moving the age later, but do not count on it moving again. Plan for 73. Now here is where the math gets interesting. If you retire at, say, 63, and you are not yet collecting Social Security, your taxable income can drop dramatically. You no longer have a W-2. You may not have Social Security income yet. You may be living on savings or a small pension. For many people, this is the lowest income decade of their adult life, and low income means low marginal tax rates. The standard deduction for 2025 is $15,000 for a single filer and $30,000 for married filing jointly. If you are 65 or older, you get an additional $2,000 per person on top of that. That means a married couple, both 65 or older, can shelter $34,000 of income from federal tax entirely. The 10% bracket covers the next $23,850. The 12% bracket covers income up to $96,950 above the standard deduction. These numbers come directly from the IRS 2025 tax tables. The right move is to fill those low brackets deliberately with Roth conversions. You are essentially paying tax now at 10 or 12% on money that would otherwise get taxed later at 22 or 24% when RMDs stack on top of Social Security. How to calculate your conversion capacity. The calculation is not complicated. You need 3 numbers: your standard deduction, your other income, and your target bracket ceiling. Start with your filing status and deduction. If you are married filing jointly and both spouses are 65 or older in 2025, your standard deduction is $34,000. Then identify your other income: a part-time job, a small pension, interest, dividends. Subtract that from the top of whichever bracket you want to stay inside. The result is your conversion capacity for the year. Here is a concrete example. Married couple, both 65, no Social Security yet. One spouse has a small pension of $18,000 per year. Their adjusted gross income before any conversion is $18,000. The standard deduction wipes out all of it. The top of the 12% federal bracket in 2025 is $96,950 of taxable income, that is income after deductions. So their conversion capacity at 12% is $96,950. They could convert roughly $96,950 and pay no more than 12% federal tax on any of it. On a $97,000 conversion, the first $23,850 is taxed at 10%, the rest at 12%. Blended rate roughly 11.6%. That is a historically low tax rate on money that will otherwise compound inside a pre-tax account and get hit at 22% or higher when RMDs begin. Individual variation matters here. Your state income tax changes this math entirely. Several states exempt retirement income. Pennsylvania, Illinois, and Mississippi, for example, do not tax IRA distributions at all as of 2025. Other states, like Minnesota and Vermont, tax them at full income tax rates. Run this calculation for your state, not just federal. The IRMAA trap. Nobody warns you about. This is the edge case that trips up even financially savvy retirees. If you are on Medicare, and most people enroll at 65, your monthly Part B and Part D premiums are not flat. They are income tested. The program is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. Medicare uses your tax return from 2 years prior to set your premium for the current year. In 2025, the standard Medicare Part B premium is $185 per month, according to the Centers for Medicare and Medicaid Services. But if your modified adjusted gross income, your MAGI, exceeded $106,000 as a single filer or $212,000 as a married couple in 2023, you pay more. The first IRMAA surcharge tier adds $74 per month per person for Part B alone. For a married couple, that is $148 extra per month, or $1,776 per year, just for crossing that first threshold. And here's the trap. A Roth conversion counts as ordinary income and pushes your MAGI up. If you convert $110,000 in 1 year and your other income puts you just above the $212,000 threshold, you could trigger IRMAA for both spouses 2 years later. That surprise bill shows up on your Medicare statement, and most people have no idea why. My take is this. The RMAA thresholds should be a hard ceiling in your conversion math, not an afterthought. Before you finalize any conversion amount, check where you land relative to the IRMAA brackets. The CMS publishes the thresholds every fall for the following year. Staying $5,000 below the first IRMAA cliff is worth more than converting that last $5,000 at 12% federal, especially if you are married and the surcharge hits both spouses. What most people get wrong about timing. Here is a widespread misconception worth naming directly. Many people think the Roth conversion decision is binary, either convert everything or convert nothing. That framing leads to paralysis. The right approach is annual conversion capacity management spread across the entire window. Consider the math of waiting. If you have $600,000 in a traditional IRA at age 63 and you do nothing, that account grows. Assume a modest 6% annual return. By age 73, that balance is approximately $1,074,000. The IRS uses a uniform lifetime table to calculate RMDs. At age 73, the distribution period is 26.5 years, so your first RMD is roughly $40,500. By 80, the distribution period shrinks to 20.2 years, and if the balance has kept growing, your RMD could easily exceed $70,000, and that is on top of Social Security, which for a married couple could be another $40,000 to $60,000 per year. Now you are looking at $130,000 of taxable income, and the 22% bracket starts at $96,950 for married filers in 2025. You are in a higher bracket than you were at age 65, with no ability to do anything about it. The data is clear. Spreading conversions across the full pre-RMD window almost always beats a lump sum conversion in a single year, because you avoid bracket spikes, IRMAA cliffs, and the net investment income surtax that kicks in above certain thresholds. Small, consistent annual conversions, sized to your bracket ceiling, compound into a dramatically better tax outcome over a decade. A full worked example, ages 63 to 72. Let me walk through a realistic 10-year scenario so this stops being abstract. Meet David and Linda. Both are 63. They just retired. David has a $750,000 traditional IRA. Linda has a $200,000 traditional IRA. Neither is collecting Social Security yet. Linda has a small pension of $14,400 per year. Their filing status is married filing jointly. Their pre-conversion MAGI is $14,400. Linda's pension, the standard deduction for a married couple, both under 65, is $30,000 in 2025, so their taxable income is zero. The top of the 12% bracket is $96,950 of taxable income. That means they can convert up to $96,950 this year and stay entirely within the 12% federal bracket. Now, they also need to watch the first IRMAA threshold at $212,000 MAGI. Their gross income with a $96,950 conversion would be $14,400 plus $96,950. That is $111,350, well below the IRMAA cliff, They are clear. They do this every year from age 63 to 72, 10 years. They convert roughly $90,000 to $97,000 per year, adjusting for bracket changes, and as they turn 65 and the deduction increases, over 10 years, they move approximately $900,000 out of pre-tax accounts and into a Roth. The tax they pay along the way is mostly at 12% federal. By the time RMDs begin at 73, the remaining traditional IRA balance is small. Their RMDs are manageable. Their Social Security is taxed at a lower rate because their total income is lower. And the Roth accounts, which now hold the bulk of their wealth, never generate another taxable dollar for the rest of their lives, and pass to their heirs income tax-free. I focus on Social Security and retirement decisions for the 50-plus crowd, and this scenario, David and Linda's window, is the one I see people leave on the table most often, not because they don't care, because nobody walked them through it before RMDs arrived. Why the legislative history matters. One more layer that most videos skip. The Roth conversion rules have changed before and could change again. Understanding where they came from helps you assess the urgency. The Roth IRA itself was created by the Taxpayer Relief Act of 1997. It was named after Senator William Roth of Delaware. Originally, only individuals below certain income thresholds could convert to a Roth. In 2010, Congress eliminated the income limit on Roth conversions entirely. That was a permanent change, and it is what makes the strategy available to everyone today, regardless of income. But the tax brackets themselves are not permanent. The current rates, 10, 12, 22, 24, 32, 35, and 37%, were set by the Tax Cuts and Jobs Act of 2017. Unless Congress acts, those rates are scheduled to expire after December 31, 2025. If they expire, the 12% bracket reverts to 15%, and the 22% bracket reverts to 25%. That means the conversion window you are sitting in right now may be cheaper than any window that follows. My take is this. If you are in the pre-RMD window in 2025, this is probably the lowest cost year you will ever have for a Roth conversion. And that statement is grounded in current law, not speculation. Act before year end. Don't wait for certainty that will never come. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video gave you a clearer picture of how the conversion window works, please subscribe. It helps this channel reach more people who need exactly this kind of information. And I want to hear from you. Drop a comment telling me which retirement tax topic you'd like me to dig into next. I read every comment and build the upcoming videos around what you're actually asking. Subscribe so you don't miss the next one. This video may contain affiliate links. I only recommend tools I use personally.